Module Overview. Financial autonomy is the lifeblood of local government effectiveness and sustainability. This module delves deeply into the concepts, challenges, mechanisms, and strategies of ensuring that local governments possess adequate and independent financial resources to fulfill their constitutional mandates and serve their communities effectively. This extensive study covers the sources of local government revenue, including own source revenue, OSR, such as property taxes, business licenses, fees and fines, intergovernmental transfers from federal and state governments, and external grants or donor funding. It explores the legal and institutional frameworks governing local finance, highlighting the importance of financial management systems, transparency, and accountability. Further, the module examines the challenges local governments face in revenue mobilization, such as limited tax bases, poor tax administration, political interference, and fiscal dependency on higher tiers of government. It also covers innovative approaches and best practices for revenue diversification, fiscal decentralization, expenditure prioritization, and participatory budgeting. The module includes comparative analyses from different federations, especially focusing on Nigeria, India, South Africa, Brazil, and the United States, to understand how local governments navigate financial autonomy in diverse political, economic, and legal contexts. Definition and importance of financial autonomy. Financial autonomy means that local governments have the authority and capacity to generate, allocate, and manage financial resources independently. It is vital for planning and delivering local services efficiently, enhancing local accountability and governance, reducing dependency on state and federal transfers, fostering local development initiatives. Autonomy involves not only raising revenue, but also prudent financial management and budgetary discretion. Sources of local government revenue: own source revenue, OSR, property taxes, rates, business licenses and permits, market fees and tolls, user charges for local services, water, sanitation, fines and penalties, intergovernmental transfers, statutory allocations, e.g., from federation or consolidated accounts, conditional grants, earmarked funds for specific projects, unconditional or block grants, matching grants requiring co-financing, external funding, donor grants and loans, public-private partnerships, borrowing, and municipal bonds, emerging in some federations as a tool for capital projects. Legal and institutional frameworks for local finance, constitutional provisions, or statutory laws, outlining revenue sources permissible for local governments, mechanisms for revenue collection and enforcement, rules for intergovernmental transfers and their disbursement, financial reporting and auditing requirements. Institutions like Revenue Mobilization Allocation and Fiscal Commission, RMAFC, in Nigeria oversee revenue allocation formulas. Financial oversight agencies monitor compliance and transparency. Challenges to local revenue generation. Limited tax base. Many localities have a small number of taxable properties or businesses. Poor tax administration, lack of updated records, inefficient billing and collection mechanisms, political interference, higher tiers sometimes withhold funds or override local taxation decisions. Economic constraints. Poverty reduces the ability to pay taxes and fees. Corruption and leakages, mismanagement and embezzlement reduce available resources. Legal ambiguities. Overlapping authority causes confusion in revenue collection. Fiscal dependency and its consequences. Excessive reliance on transfers reduces local autonomy and incentivizes poor fiscal discipline. Creates vulnerability to political manipulation. Limits planning and responsiveness to local needs, often leads to underfunded service delivery, innovative revenue mobilization, and financial management practices, property tax reforms with better valuation and collection techniques, use of technology and e-governance to improve billing and payments, adoption of participatory budgeting to enhance accountability. Introduction of local development funds or special levies for infrastructure. Exploring municipal bonds or credit facilities for capital projects. Strengthening financial transparency and public auditing. Comparative perspectives, case studies. Nigeria. Heavy reliance on statutory allocations from Federation account. Weak OSR due to poor enforcement. Joint state-local government account limits direct access to funds. India. Panchayats empowered to levy taxes but still reliant on grants. Decentralized budgeting reforms in some states. South Africa. Municipalities have broad taxing powers and access to grants. Strong financial oversight by Auditor General. Brazil. Constitutional guarantee of municipal revenues. Use of participatory budgeting and innovative financial tools. United States. Local governments heavily reliant on property taxes. Municipal bonds widely used for infrastructure finance. Pathways to strengthen financial autonomy. Constitutional and legal reforms to guarantee local taxing powers. Capacity building in tax administration and financial management. Transparent and equitable intergovernmental transfer systems. Promoting fiscal accountability and citizen participation. Leveraging technology for revenue collection and financial reporting. Encouraging local innovation in resource mobilization. Learning outcomes. By the end of this module, you will be able to define financial autonomy and explain its significance for local governments. Identify and critically assess the sources of local government revenue. Analyze legal frameworks governing local government finance. Recognize challenges inhibiting local revenue generation and fiscal autonomy. Recommend strategies and best practices to enhance local financial independence and accountability.